Welcome to Neko Hina's tutorial. Please like this video, comment, and subscribe.
The information provided on this podcast is for educational and informational purposes only and should not be considered financial, investment, or legal advice. I am not a financial advisor, and the strategies or assets discussed may not be suitable for your personal financial situation. Investing involves risk, including the loss of principal. You should always consult with a licensed professional before making any financial decisions.
It is easy to look at a 10 or 12% advertised yield and think you've found a cheat code for passive income. But high passive income requires a direct exchange. You are trading away your portfolio's future capital appreciation in return for immediate monthly cash flow. If you are looking at covered call ETFs, you are likely debating between four heavyweights: QYLD, QQQI, JEPI, and XYLD. We can categorize these funds first by the index they track, the S&P 500 on the left and the Nasdaq 100 on the right. On the y-axis, we separate them by risk profile. At the top are funds built for maximum yield with uncapped downside risk. At the bottom are funds structured with defined downside protection. XYLD sits top left, JEPI is bottom left, QYLD takes the top right, and QQQI anchors the bottom right. To find the right fit for your portfolio, we must look at index volatility, the specific option mechanics, how they survived actual market stress, and their tax efficiency. Picking an income ETF based purely on the yield percentage can lead to severe principal destruction. You have to evaluate the structure underneath. Round 1 begins with the funds built on the Nasdaq 100. The Nasdaq 100 is concentrated in mega-cap technology and growth stocks, which makes it a volatile index. For a covered call fund, volatility is the engine. Wide market swings allow fund managers to capture higher option premiums, which is how they generate those 10 to 12. The index is only half the story. QYLD and QQQI track the same index, but their underlying mechanics produce very different outcomes. QYLD operates by writing naked at-the-money call options against its portfolio. It passes almost all of that premium directly to shareholders, maximizing the monthly payout. This line represents QYLD's risk. Profits are capped when the market rallies, with no downside protection. If the Nasdaq crashes, QYLD drops with it. Contrast that with QQQI's protective put color. Upside is still capped, but you gain a flat horizontal floor on the downside. To build that floor, the fund uses a portion of premium to purchase put options, guaranteeing a mathematical limit on losses. Buying those puts costs money, eating into the net distribution, dropping QQQI's yield several points below QYLD's. Naked call strategies maximize income at the expense of your principal. Protective collars ensure you survive a crash, but you pay for that safety with a smaller yield.
We can see how these mechanics hold up by looking at historical stress tests, starting with the 2022 tech bear market. In 2022, JEPI fell just 3.5%, and XYLD dropped between 5 and 7%. QQQI fell 10 to 15%, while QYLD took a 20 to 25% hit. The S&P-based funds successfully preserved capital because their underlying index didn't collapse. QYLD, tethered to the Nasdaq with no downside floor, took severe, permanent damage to its net asset value. Now look at the 2023 and 2024 AI-driven bull market. The Nasdaq funds easily outpaced the S&P funds. QYLD delivered 35 to 40% total returns, and QQQI captured 25 to 30%, while JEPI and XYLD stayed in the 20 to 30% range. But there is a catch to that bull market data. An unhedged Nasdaq index fund would have nearly doubled over that same period. Covered calls mathematically cap sharp rallies, regardless of whether you choose the S&P 500 or the Nasdaq. These funds force you to forfeit extreme growth in exchange for your yield. There is one final variable that dictates how these funds perform: tax friction. The IRS does not treat all dividends equally. The distributions from funds like JEPI and QYLD are primarily categorized as ordinary income, not qualified dividends. Here is what happens holding a 10% yielding fund in a standard brokerage account. In a top tax bracket,
Ordinary income taxes cut away nearly a third of your payout. That advertised yield instantly shrinks to a 6.5 or 7.5% real return. Funds like XYLD and QQQI attempt to mitigate this by using Section 1256 index options and return of capital accounting, which can defer some liability and offer a slight tax edge. A 12% yield is only useful if you can actually keep it. Tax drag dictates exactly where these funds must be held. Each of these funds is built for a different portfolio goal and a different tax situation. To find your match, start with one question. What is your primary goal? If you want maximum income, believe in Nasdaq compounding, accept uncapped risk, and hold your assets in a Roth IRA to avoid taxes entirely, the winner is QYLD. If you want high Nasdaq exposure but demand a defined maximum loss floor to survive a market crash, the winner is QQQI. If your goal is capital preservation, typically a retiree prioritizing stability over raw yield, and you are keeping it sheltered in a 401k or traditional IRA, the winner is JEPI. And if you want conservative S&P 500 income, but you are forced to hold it in a taxable brokerage account and need the potential tax efficiency of direct options, the winner is XYLD. The greatest mistake retail investors make in this space is buying a fund based purely on the yield percentage without understanding how the income is generated. Success in passive income requires matching the index to your risk tolerance, the option structure to your goals, and the fund to your account type.
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then!